G'day guys, and welcome to this business management lesson. In today's lesson, we're looking at key knowledge point 122. That is Unit 1, Area of Study 2, and the second key knowledge point for this area of study. Today specifically, we're looking at types of businesses, and helpfully this key knowledge point gives us a list of the different types of businesses we need to talk about. We also need to consider the factors that would affect your choice of business structure. Now, we'll begin by talking about sole traders. This is the first business type listed in this key knowledge point, so that's where we're starting. A sole trader is a business that is wholly owned by one person and that person alone. Some texts, some textbooks, some references will define a sole trader as being owned and operated by one person. But honestly, that's kind of misleading. Let's say, for example, you start your own business in your bedroom, selling things over the internet. And in a few months, maybe in a few years, your business becomes a bit more successful. You hire a couple of people to work for you to help package the product that you're manufacturing and selling. Maybe a few years after that, you have to move into a warehouse space. Your business is growing and growing. All the while, it's still your business. You are the sole owner of that business. After a few years, maybe this business has grown even greater. You've hired more employees. You've hired some managers to manage those employees. And after 10 or 20 years, you feel like you've had enough. You hire someone responsible for managing your business. You've got an accountant. You've got lawyers. These people all work for you because you're the business owner. Maybe you move to Hawaii and live on the profit of your business. Once you've stepped away from the business, it doesn't stop being a sole traded business. You're still the business owner on your own. You can have as many employees as you like. It doesn't stop your business being a sole traded business. And that's something that a lot of students get wrong because of the ambiguous way some texts define sole trader. So keep that in mind as you work through this area of study, that as far as you need to be concerned, a sole trader is a business that is wholly owned by a single individual. Now, being a sole traded business carries with it some quirks that are unique to the sole traded business model. One of those is that in Australia, businesses need to register their business name. There is an exception, however, for sole traded businesses. If the business that a sole trader owns just uses the owner's name, for example, Daniel Murphy, if your name is Daniel Murphy and you want to sell alcohol out of a shop, you wouldn't have to register your business name with the Australian Securities and Investment Commission, ASIC. However, if you want to give your business a name that's different than your name, or if you're any other business type, you need to register that business name with ASIC. One of the conditions, one of the characteristics of a sole traded business that helps us identify that it's a sole traded business is that a sole traded business has what's called unlimited liability. That means in the eyes of the law, the business and the owner are the same legal entity. Any debts that the business racks up are debts against the owner's name. So if the business runs into a huge amount of debt and has to start selling off assets to raise capital to pay off that debt, well, the owner's house, the owner's car are going to be considered fair game assets for the bank to seize or for debt collectors to come and claim when trying to recoup those losses. Certainly, if the business is found to breach legislation and is sued or has charges brought against it, because of that unlimited liability, it's the owner who would have to front up in court, and those charges would be leveled at the owner as well. So, advantages and disadvantages of a sole trader. A sole traded business is simple and inexpensive to set up. Even simpler than any other type of business, because if you're just using your own name, you don't even have to register your business name. In a sole traded business, one of the advantages is you don't have to share. You don't have to discuss decisions before you make them. You don't have any partners, so you're in full control, which also means you don't have to share any of the profits that you make, and you get to keep those all for yourself. And a sole traded business being a very, or at least relatively very simple business structure means that there's minimal government regulation and intervention in the operations of sole traded businesses. Of course, difficulties include that unlimited liability. It's also very difficult to gain finance as a sole traded business. Banks typically don't offer huge volume loans to sole traded businesses because they've got that unlimited liability, And in reality, there's a huge burden on the owner's skills to make this business a success. If you're very charismatic and a wonderful salesman, but perhaps you lack certain financial management skills, because you're the only person responsible for this business, that's going to have a huge impact on the business. And that's why we identify there being a large burden for a sole trader. And that also explains why banks might be a bit more reluctant to give finance to a sole traded business owner. Now, this type of business, the partnership, is very similar to a sole traded business, except now, instead of one owner, there's more than one owner. Typically, partnerships aren't owned by too many people. Up to 20 seems to be about the reasonable maximum, simply because beyond that, there's too many people involved in that team project. One of the key components or characteristics of a partnership is that while this business type also has unlimited liability, partners can share in the liability for at least quantifiable measures. Let's say the business racks up $1 million worth of debt. Well, then in a partnership, perhaps if there are two partners, they might each take responsibility for paying off $500,000 of debt each. And that sharing of the burden and sharing of the responsibility can make a partnership less risky, or a less risky endeavor for the people involved in owning this business. Of course, unlimited liability doesn't just extend to quantifiable measures. If the business is sued for a breach of OH&S legislation, then all of the owners will be responsible for fronting up to those charges. It's certainly important when we're talking about a partnership that the owners communicate and outline their roles within a business. If you've ever done any group work at school, you probably have a sense that group work has a habit of resulting in one person doing the lion's share of the work, and it can be kind of unfair and a bit disenfranchising for the people involved. So certainly if you're going to work with other people in owning a business together, it's important that you outline your roles carefully. Advantages for a partnership. Once again, very simple and inexpensive to set up. A little bit less simple than a sole traded business, because for a partnership, you'll absolutely have to register your business name. There's no get out of doing that sort of system for a partnership, because you can't just use two people's name without registering it with ASIC. Certainly, one of the advantages over a sole trader is that in a partnership, the workload can be shared amongst the partners. Workload to do with owning and managing this business, and certainly workload to do with setting it up in the first place. And certainly, risk and debt can also be shared amongst the partners. However, and here the disadvantages are quite similar to a sole traded business, that unlimited liability is still a bit of a risky prospect for business owners. There's the potential for disagreements with your partner now that you have to share. There's also the possibility that you'll end up being responsible for debts incurred by other partners. And finally, while it was an advantage that you didn't have to share with a sole trader, it's a disadvantage that you might have to share if you are in a partnership. Now, if you had a sole traded business or a partnership business, you had what is called an unincorporated business. Once a business goes through the process of incorporation, it becomes a corporation or a company. Companies are no longer owned by owners, they are owned by shareholders who each own a share of the business. And one of the great benefits of incorporation is that the company is now a separate legal entity from the shareholders. If the company racks up debts, the shareholders will not be responsible for paying off those debts. If the company is found to have breached legislation, perhaps the managing directors or the managers within the business might be responsible for that, but the shareholders are insulated. They're protected from that because that's a separate legal entity. And certainly, now that the company is its own legal entity, it can pay the company tax rate, which is much, much lower than the personal tax rate that our unincorporated business models had to pay. There are two types of companies that we'll talk about: private limited companies and public listed companies. Private limited companies are companies where the shareholders control the sale and purchase of shares. Their sale is very private. For someone to buy shares in a private limited company, all of the existing shareholders have to approve that purchase. And if someone wants to sell their shares in a private limited company, the other shareholders all have to agree that that person has permission to sell their shares. It's a very controlled process. Because of this, typically you don't see private limited companies with more than 50 shareholders, because getting everyone to agree if there's 50 or more shareholders is going to be an arduous task, and all you need is one grumpy old person in the corner saying no every time they're approached for their thoughts on a purchase request, and that could throw a spanner in the works for everyone. So 50 typically is the absolute maximum. A private limited company, as with any type of company, as we've just discussed, benefits from having limited liability, which means it's a separate legal entity. And one way you can identify private limited companies in Australia is by law, they are required to have the words proprietary limited, or the shorthand for that, PTY Ltd, after the business name. One example of this is VCE Proprietary Limited, who are a very well-established Australian company that perhaps your teacher will tell you more about in classes. But that's one example you can look at to learn more about private limited companies. One advantage of being a private limited company is that limited liability. It's a really attractive prospect for shareholders. Certainly, it protects the owners of this type of business from the sorts of risk that the owners of unincorporated businesses have to deal with. And certainly, because it's a separate legal entity, they pay the company tax rate. Now, just broadly speaking, the personal tax rate tends to be, at a minimum, double what the company tax rate is in Australia. So if you're talking about a business that's earning millions of dollars a year, being able to cut your tax bill in half at a minimum is going to be a very attractive prospect for a business. And certainly one advantage of being a company is the company will be bigger than the founders or the directors. If you start a company and you grow old and decide to retire, if it was a sole traded business that you had started and you step away, that's probably going to be the end of the business. If it's a company and you decide to step back, other people can be brought in, you can sell off your shares, and other people can be brought into that company to keep it going and keep your legacy operating. Some disadvantages are, however, that the process of incorporation is very complicated and unbelievably expensive. You'll need lawyers and accountants to make that a possibility, and it is a fraught process. And certainly, once a business is incorporated, they have all sorts of legal requirements around reporting, and certainly the government will have much more, or significantly more requirements of an incorporated business. So in terms of reporting, there are a number of things that businesses need to consider here, which can take a lot of time and certainly might compromise the efficiency of the business. And certainly a disadvantage for a private limited company is the shares can't be traded freely. If a business wants to sell off shares to make some money, to make some capital for the business to use to invest that money into growth or into a new project, because the shares can't be traded freely, that's not really a possibility for a private limited company, unless all of the shareholders agree. The alternative type of company is a public listed company. And if a private limited company is one where the sale of shares is private and it's limited by approval from the shareholders, well, a public listed company is one where the sale and purchase of shares is entirely public because these shares are listed on a stock exchange. In Australia, our stock exchange is the Australian Securities Exchange, or the ASX. And any Australian business, that is a business who is headquartered in Australia, who is a public listed company, will list their shares on the Australian Securities Exchange. And if you can afford to buy shares in a company, then you can buy shares in those companies if you would like to. Public companies have limited liability, just like private limited companies. So the shareholders of a company are protected from debt if the company goes into receivership. The shareholders of a company are protected from prosecution if the business is found to be breaching legislation in some important way. What's important to understand about business, just for terminology's sake, is the first time a business lists their shares for sale on a stock exchange is called a share market float or an initial public offering, an IPO. That terminology is something you should be looking for when you're reading case studies. Your teacher might like to throw that in there to indicate that we're talking about a public listed company. So initial public offering or share market float is something to be looking for. Now, shares can be purchased by any member of the public who can afford to buy them, as long as there's not some sort of legislated reason that they can't buy shares. And that sort of thing does crop up from time to time, but generally speaking, members of the public can buy shares in public listed companies. And one way to identify a public listed company, if your teacher hasn't told you that they're listed on the ASX or that they've gone through an IPO or a share market float, is to look for just the word limited or just the shorthand for limited, LTD, after their name. And one example of an Australian public listed company is BHP Limited. Advantages for a public listed company include the limited liability, the fact that it's a separate legal entity, the fact that it pays a company tax rate and is bigger than the directors. And we should also say that a public listed company doesn't have the disadvantage of a private limited company. If a public listed company wants to raise capital through selling shares, it's free to do so, and it can do that quite rapidly. Disadvantages of public listed companies, however, are, well, once again, incorporation is a very complex and time-consuming process. And certainly, going through the process of setting up for an IPO, an initial public offering, is also highly complex and expensive and time-consuming. There are very high costs associated with all of this. When you have to pay lawyers and accountants to manage that process, you're going to be spending a lot of money. And certainly, public listed companies have the highest level of accountability and compliance, not just in government reporting, but also in keeping these mysterious public shareholders happy. Shareholders own your business, and it's quite possible that if they decide you're not doing a good job, if you're the director and you're sitting at the head of the board, the shareholders decide that the business isn't profitable enough, they might vote to sack the board, which means that suddenly you've lost control of the company that you founded. So that is one disadvantage of a public listed company. It won't really be a problem if you're doing a very good job and you're keeping your shareholders happy, but it is possible that if times become tough, the economy turns, your business becomes unprofitable, that the shareholders might take out their frustration on you and remove you from management of your own business. Now, social enterprises. This is a bit of a funny one. Social enterprises, we're not talking about ownership. The last 4 business structures we spoke about were legal ownership structures. A social enterprise is typically a private limited company, but it can be any type of business. What the defining feature is of a social enterprise is that rather than prioritizing financial objectives, rather than being driven by a pursuit of profit and a desire to fulfill shareholders' expectations of valuable dividends and growing the share price, a social enterprise has the primary objective to fulfill a social need. They're still a business, they still sell goods and services for a profit, but then they take that profit and invest it into fulfilling a social need. An example of this is Thank You, and if you've ever walked down the beverage aisle in your supermarket, or if you have much to do with babies, you might be aware of Thank You. They make nappies, they make body wash, and they especially make bottled drinking water. They sell all of those products to make a profit, and then they take those profits and invest that into projects to dig wells and provide other clean drinking water infrastructure in communities around the world that don't have that infrastructure in place. So they're doing a great amount of work in that area, bringing clean drinking water to communities that don't have it. Some advantages of social enterprises would include that meeting that social need, that social work that can be traced back to the company, will help build community support. And certainly, while I know for myself I don't buy bottled water very often, when I do, if Thank You is there on the shelf, I'll always reach for that, because I can feel, while I am using a single-use plastic product and I feel a bit dodgy about that, I know that at least my money is helping contribute to good somewhere in the world. And certainly that is true. When we look at the market share of social enterprises, typically they are much greater, much more competitive than a business that size with that marketing budget would be expected to be within a market. So typically a social enterprise has an easier time winning over customers. And certainly for employees, if you're working in a business like Thank You and you know that your business is having a really positive impact on the world, your morale is going to be much higher. And so employees who work in these kinds of businesses are typically more motivated and engaged with their work. They know that they're contributing, and they'll be more productive and efficient as a result. Of course, disadvantages of social enterprises are they have a very difficult time, or a great challenge, balancing their financial objectives and their social objectives. It's important for social enterprises that they are profitable, and it's very attractive for them knowing that they can spend their profits to fulfill this social project. So it might be that they want to grow their business, they want to increase their market share, they want to increase their distribution into new markets, so they might want to reinvest in the business side of things to try and build their profitability so that they can fulfill their social needs. But that's a bit of a delicate balancing project. How much money do you reinvest back into the business? How much money do you allocate to fulfilling your social needs? It's an ongoing and complex equation to solve. And certainly for a social enterprise, it can be really difficult to raise capital. Where a public listed company can just sell shares, or a private limited company can try and attract investors, a social enterprise has to try and attract philanthropy. Someone who's going to invest in a social enterprise is going to do so knowing that the social enterprise isn't going to make the investor rich, but it would be someone who is investing because they believe in the social objective of the business. And that can be much more difficult to find in a capitalist investment economy. Now, a government business enterprise is much like a private limited company, except instead of having private shareholders, they have one shareholder, and that is the government. There are some government business enterprises owned by state governments, but by and large, the ones you'd likely be familiar with are ones that are owned by the federal government. There are businesses that used to be government business enterprises, like Qantas or the Commonwealth Bank, but those have long since undergone the process of privatization, where the government sold its stake in the business to private investors, and those businesses became public listed companies a long time ago. But Australia Post, NBN Co, and DHA, or Defence Housing Australia, are still modern examples of government business enterprises. These are businesses that undertake commercial activities, they sell goods or services, they try and be competitive in the market, and it just so happens that their one and only shareholder is the government. So, well, that's their whole story, right? We know what a private limited company is. We know that they sell things. The GBE tries to sell things and be profitable and make profit that they can return to its shareholder, but that shareholder is the federal government, which is just an interesting quirk of GBEs. Some advantages of GBEs, or government business enterprises, include that they can rely on government for initial investment and capital, and often governments have access to funds and resources that entrepreneurs could only dream of. So government business enterprises are often equipped to hit the ground running in a much more effective way than other businesses might be. And certainly one advantage is because they've got this access to significant funding from the government, they can provide really healthy competition to the private sector. And certainly if we look at something like AusPost, despite them having their challenges in the modern ages, they largely establish a standard that private mail distribution companies have to contend with. So if you think about your parcels when you buy something off eBay or from Amazon and how they get to you, if they're not coming from AusPost, they're coming from a company that has had to look at what AusPost is doing and look at the prices that AusPost charges and plan their business around that and be more competitive in some other way. Maybe their postage is faster, but they can charge the customer more for that, or maybe their postage is the same level of efficiency and reliability, but they charge slightly less than AusPost. AusPost has this role of being healthy competition in the market. And certainly, government business enterprises, and this is sort of an advantage for everyone, because they have that high government investment, they can develop infrastructure that private companies may be less capable or more reluctant to invest in. So certainly, government businesses that use a large amount of imports and exports, might invest in warehousing and wide roads around the ports and around the docks so that trucks have easier access in and out. And if Ozpost has done that, then other companies will be able to set up in the same sort of area and take advantage of that. Or certainly, if a government business enterprise, such as historically Qantas, is building wide roads and access to an area that will later be designated an international wing of an airport, well then certainly private airlines and air carriers can also use that infrastructure to make their businesses more viable also. Some disadvantages for GBEs, however, is that government isn't forever, and in Australia, on a pretty regular cycle, we have elections, which means that your boss, if you're a GBE, can change pretty regularly, and your strategic direction, which comes from your shareholder, the government, can change with it. And it may be very inefficient for a GBE to be operating within the sphere of government, because it's a bit of a stereotype that governments are wildly inefficient, and there's a lot of red tape or a lot of policy things that people need to deal with within government, and that might flow down into the administration of a GBE. There can also be political interference. If you're familiar with the Ozpost scandal from the last federal government, you would have a bit of a case study to understand what that point means. If you don't know about it, you can look it up. It was a bit of a saga, pretty interesting. And certainly we need to understand that government business enterprises, because of the inefficiencies caused by government interference and government red tape, GBEs might not be as productive or as efficient as private sector businesses. While they've got a lot of funding from the government and there's a lot of inefficiencies coming from the government, it's quite possible they're not driven to be as productive and efficient as a private sector competitor. In summary for this key knowledge point, there are multiple types of businesses and they each have their own advantages and disadvantages. And here's where that last little phrase in the key knowledge point comes to play. Your choice of a business structure will depend on many factors. If you are on your own and you don't have a lot of finances to pursue incorporation, then perhaps a sole traded business is going to be right for you. You need to understand the advantages and disadvantages of a sole traded business before you make a decision to pursue that. But if unlimited liability is something you can live with, and knowing that you'll pay personal tax because of that unlimited liability, if that's all something you can live with, then a sole trader is going to be right for you. If you look at these factors and decide that you don't actually have all of the necessary skills to pursue business on your own, perhaps you want to look for a business partner and pursue a partnership. And then at a different time, if you do have the funding and resources necessary to consider incorporation, perhaps then you would decide that that is right for you also. So be aware that when it comes to deciding on a type of business or a business structure, you need to weigh up the strengths and the weaknesses of each type of business and make an informed argument about why one type of business is going to be especially right for your context. The types of businesses that we talked about today include sole trader, partnership, private limited company, public listed company, social enterprise, and government business enterprise. That's all for today. See you next time.